Hey everybody, it's the 27th of January. It's been quite a quiet week on the market. It's been really hard to find things to trade, so I wanted to take a quick second. We'll have a look to a couple of important news events, economic releases that are coming out next week. Let's see, just very briefly, this is the FTSE. It's been about a 70 or 80 point range all week between here, so it's very no volatility, very little movement. So it's been a real challenge to find things to trade. So we're just going to take a couple of minutes to have a look at a couple of economic releases next week. Things that they're not going to suddenly change things overnight, but I think they're important. These two things in terms of building up a picture in our minds going forward as to interest rates really and central bank policy, because if you watch these things month after month, eventually we're going to hopefully build up a picture of where things are going to go. And in my opinion, the two sort of crucial things going forward are going to be this relationship between building inflation, rising inflation, and interest rates, and whether sort of inflation, it is picking up, doesn't pick up too fast, and central banks can keep interest rates at lower levels for longer, which will keep things going. But if there's suddenly pretty sharp inflation and rates have to start going up pretty steadily, I think we're going to run into some problems. I mean, a lot of this is built on sort of cheap money, and in my opinion, sort of the amount of money that's been printed is completely reckless by central banks at this point. It's been way too much, and the premium we see built into the shares, is off the back of QE and off the back of historical low interest rates for a long period of time now. So the whole sort of thing is going to be watching when we get back to quote unquote normal monetary policy, i.e. higher interest rates, less money supply, and a more normal system where people who want to save money in the banks, for instance, actually going to see some return on that, instead of really just massive amounts of consumer spending. It seems to me at the moment nobody's saving anymore, and everybody just spend. But have a look at these couple of things I'm going to be watching next week. As I say, it's not going to change things overnight, but important to build up a picture going forward. So, first one's the German inflation rate. It's the one with the red highlighted red. It is pretty important. Last time it was 1.7. It's forecast for 1.9. Consensus at 2%. So the ECB has one of their main, along with employment, is price stability, one of their main sort of mandates, and their price stability mandate is not to let inflation get over 2%. Now, if you look at the month-on-month reading, I mean, you see the big jump. It's really sort of started to spike a little bit, which is not surprising given the amount of QE that's gone off, given the amount of money that's been printed, and the historically low rates of interest. So it was sure to stoke some inflation at some point, and up to a certain point, something like the eurozone, it needs it. Problem comes if, and we've got to keep watching this going forward. If it starts to get out of hand and it starts to rise rapidly, then there's going to be some real problems in the eurozone. I mean, at some point, I think they say they're going to keep it at the end of the year. If it does get out of control, A, they're going to have to look at increasing interest rates, and B, they're going to have to start looking at scaling back QE and printing less euros. And the problem is, as I see it, is if the European Central Bank is not going to buy Italian, Greek, etc., all those sort of countries, not going to buy their debt, I'm not sure who is. And we've seen it all before if you cast our minds back to 2011, if you think about April 2011 in particular, when rates went up just 0.25% from 1 to 1.25, and obviously few weeks after that, Portugal needed I think it was about an 85 billion euro bailout. So I don't think this Eurozone crisis is over. I think the can has been kicked down the road, really, and it's been allowed to sort of drift away from our minds because of a lack of inflation and the fact that the ECB has been able to constantly step in, buy the bonds, and keep the interest rates, the long-term interest rates of these countries, keep them artificially suppressed. So these sort of numbers like this one next week, vitally important. As I say, it's not going to suddenly change things overnight, but eventually, I believe this is going to be a big story going forward. So it's important to watch it, and it's important to watch the ones going forward, so we can build up a pattern in our minds of where things are going in the longer run, because there will be risks to the economies, to the banks in Europe. And there'll be risks to the general world economy stock markets as well, from rising inflation, I believe. And the second one is obviously it's the first Friday of the month next week, first Friday of February. So as always, non-farms. I mean, they're okay. They're not great numbers. But again, it's going to be important to watch things, especially the non-farm, to build up a picture in our mind of what the Fed may or may not do this year. I mean, it seemed to be after the last, after the December hike, people seem to think, the consensus seems to be that they're going to do 4 rate increases next year. And I'm not convinced that will or can happen. I mean, if you think about the US in a huge amount of debt, and if you look at the way the rates have moved, if you look at the treasuries, if you look at the mortgage rates and the way people are perceiving things in the US, or the way the markets are perceiving things, sort of higher interest rate climate is already being priced in. Now, Donald Trump has all these ideas on infrastructure spending and creating jobs. Now, he's going to need to borrow even more money than they already have borrowed to fund this. And the only way that this can happen is off the back of a weaker dollar and of easy monetary policy and of us keeping their borrowing rates as lower levels as possible. I mean, I'm not saying there'll be QE4. I hope there won't be QE4. I think that would be a disastrous thing for the central banks to do. I mean, it really, really cause some problems for the dollar itself. But I mean, nothing would surprise me. Like I said, they've been, in my opinion, so reckless for the last few years. It wouldn't completely surprise me if they did something like QE4. But I can't see there being 4 rate hikes next year. And the non-farm numbers, these sort of things, are going to be vital to watch, because Yellen's pretty dovish, and she'll seize up on anything, I think, to sort of delay having to put rates up as much as possible. I mean, we've seen them bottle it a few times in the last year or two. So I'm not convinced about 4 rate hikes this year, but we shall see. But again, watching these really important, everybody, to watch these every month, make a note in your diary or whatever, and build up a picture in your mind of where these sort of things may be heading. Okay, so that's it. Enjoy your weekend, and we'll see what happens next week.